And joining us now with a closer look at China's economy is Patrick Chovanec, Managing Director and Chief Strategist at Silvercrest Asset Management. Patrick, thanks for joining us. The latest data out of China, both from the industrial output and from the fixed investment, is indicating a slowdown. What's the reason behind this?
Well, the NDRC, China's top planning commission, when they made the report to the National People's Congress in March, they pointed out three reasons why the economy was sliding. The first is that consumption just isn't powering the economy like people want it to be. Second is that companies are either unable or unwilling to invest in levels that they were. And then the third is that local companies, that's right. And the third is that the export environment really hasn't improved that much. So these three things are really a recipe for a decline in China's GDP growth.
Is there anything that the government can do about this without overheating inflation or causing more bubbles in the property market or causing more concern about a bubble in the property market?
Well, that's the real concern because, right now, if we see Chinese growth decline, that's not necessarily a bad thing if it's happening for the right reason. If it's part of an economic adjustment away from dependence on investment and exports towards more consumption, then that's a good thing. But unfortunately, that's not what we're seeing. What we're seeing is a deluge of credit, much of it off balance sheet, that's trying to prop up investment, but it's not propping up investment to the degree that it was before. So we're getting less and less GDP bang for the stimulus buck. So
is there any recourse here for the government?
I think it's really to embrace the fact that there's a real economic adjustment that China needs to undertake, as opposed to trying to stave it off.
Now, while industrial output did not meet the expectations, the long-term strategy for China has been to boost domestic demand. And in the first 3 months of the year, services accounted for a record 47.8% of GDP, overtaking industrial output. So isn't this a good news? Because this is the direction that the government wants the overall economy to be going in long term.
I think that we're seeing some shift, inevitably, towards a rebalanced economy. But unfortunately, there are a lot of things that the government could do, such as maintain a stronger renminbi, actually raise interest rates as opposed to lowering them, in order to rein in investment, and also to change the tax system to shift resources back to the household sector. Now, the government has come out with a plan to do these things. Actually, there are several plans to do these things, but so far it's yet to really materialize except on paper.
Are we likely to see any of these measures materialize?
I hope so, and I think that there is a mounting sense of urgency about it. The Politburo had a meeting about 2 weeks ago, in which they seemed to knuckle down and come up with some proposals, but it's not clear whether any of those proposals will be implemented before October, and that's a long time to wait.
Do you think that the government target of 7.5% GDP is still attainable?
I think that the government really shouldn't be focused on GDP targets. In fact, the government in its 5-year plan said that they would not set a GDP target and that the focus should be on quality growth, not quantity. And yet we still come back to this notion that China has to hit GDP targets regardless of what that GDP growth consists of.
So what do you mean by quality growth then?
I mean a shift towards consumption as opposed to investment. You can shove investment out the door, and whether it's good investment or bad investment, it counts as GDP. But it really stores up trouble for the future. And one of the problems that we're having right now is that there's a lot of bad debt clogging up the system, and it's eating up a lot of the credit in the system and the ability to generate new growth.
Well, the credit has been loosened considerably by Chinese standards. Do you think that we should see a tightening then?
It's not a question of tightening. It's a question of trying to rein in and be selective about investments. Unfortunately, right now, anything shy of 20% credit growth, total credit growth, feels like tightening because the economy is addicted to easy credit.
Right.
And really, what China needs to do is move away from that addiction to easy credit.
That addiction is not just happening in China, happening across the globe. Thank you so much, Patrick Chovanec, Managing Director and Chief Strategist at Silvercrest Asset Management.